Hi, Dominique. Welcome again to another installment of the week ahead. And as we always like to do, let's start with kind of recapping this past week, where, what's your interpretation? It seems traditional thought of kind of how high inflation is and even growth hanging in there. And yet the bond market doesn't seem to be totally reacting maybe in the way that people think. So how would you interpret the past week?
Okay, so I feel a little bit lonely out there, but in good company with Larry Summers and my former boss at the New York Fed, Bill Dudley. The inflation dynamics are horrible. We are headed towards double-digit core PCE. And the Fed seems to not be too worried about it. I think, we had, what is really unfortunate is that the Fed discussion and consensus building have spilled into the public domain, which is adding volatility to the markets. I think we are headed towards a 75 hike this week, which is very unfortunate because it will further bring the Fed behind the curve. Talking about the bond market reaction, there is this exaggerated fear of a recession. But, whether it's exaggerated or not, there is a much bigger issue with the curve inversion, which is it's blocking the transmission of tightening to the economy. Look at what's happening to mortgages, how they've come down, largely because they are tied to the 10-year. And, when the Fed talks about hiking, the 10-year doesn't go up, it goes down. So I think we are really at a sort of a watershed here where things, inflation dynamics could get worse over the next few months in a very significant manner.
Just a quick question on that. So what can they do to kind of counterbalance all this, curve inversion? Can't they run off the balance sheet much faster? Would that have an impact or the desired impact?
So that is definitely what is coming next. And definitely the outright sales of MBS are going to happen because we have a cap, as you know, for MBS, but it's a totally irrelevant cap because with mortgage rate at 6% when they were 3% a year ago, there's no way people are going to refinance or refinances are going to be very small. So definitely. And then there is a broader issue, which I intend to address in future research. So I hope our listeners will read it. Yeah, will it be enough to invert the curve? I think not, because when it comes to the long end of the curve, the Fed is one of many players, by contrast with money market, where the Fed is obviously the dominant player. And that's why for years, monetary policy has been focused on the short end rather than the long end of the curve. So we shall see. It will make a difference. I'm not sure it will be a significant difference.
One thing, we'll go on to any other thoughts for the past week and then the week ahead. But one thing I was thinking is that maybe helping to cause this inversion is the ECB is moving so slowly and the BOJ has still YCC in the 10-year. Like there is a point that some of those flows and the spreads are probably inhibiting maybe US longer end yields to go much higher, or do you think that's not really?
And Joseph, I think this is a really important point that you are making here. Obviously, markets are global, and what is happening in the Eurozone and in Japan is certainly pulling down US yields. But again, we don't know to what extent.
Right.
And also remember, my best case scenario is that the US has to have a recession to bring down inflation. So it's not clear whether we will go from inversion to disinversion when, say, the ECB and the BOJ come to their senses, or it becomes obvious that growth is not collapsing. And then, invert again when it becomes clear, everybody agrees that the Fed has no choice but to engineer a recession, or whether we will stay inverted all the way and invert more. And obviously, the latter is a bit of a pickle for the Fed, because it would block the transmission of policy to the economy.
Right. In the end, credit conditions are not as tight as they'd like to see because of this inversion now, like you said,
Definitely.
especially like things like housing.
Yeah, absolutely.
So, okay, and looking forward, what do you see as the most important things for the coming week that our investors should be thinking about?
Well, I think investors may have a week of respite. The Fed cannot talk since they are in the blackout. And based on the comment of the FOMC members, it looks like in the end it will be 75 in 10 days. So the worst that investors have to fear from the Fed this week is another Timir House article telling us that it's 1% and not 75 basis points. I mean, this is the way the Fed decision process has evolved, is really adding a lot of volatility and risk to market. So we'll leave it at that. In terms of data, it's also a fairly light data week. Perhaps the thing to look for is what's happening to hospital admissions, COVID-related hospital admissions. They are up. And one risk, which is definitely not my base case scenario, but not a tail risk either, is another public health scare. So keep an eye on that. Otherwise, the S&P PMIs, which are, always lagged relative to the ISM. So we want to watch them, but the excitement has been taken by the earlier publication of the ISM surveys, and a bit of housing data, the TIC, and the usual claims data, which by the way are going up, but basically going back to pre-pandemic trends.
Right. They're still super low at this point.
Yeah.
Okay. Yeah, it's so right now, for you and your kind of core thesis, it's really 2-year yields, say 2-year US yields, to continue heading much higher.
Definitely.
Yeah.
I mean, the story about the CPI surprising on the upside, the Fed going back and forth on 100 or 75 basis points, the fact that they are so far behind the curve and still not doing 100, which wouldn't be extraordinary. The Bank of Canada did it. It just shows that they are in denial about the scale of their inflation problem. So that suggests my scenario of a capitulation with the Fed publishing a SCP with 8% Fed funds and unemployment in the neighborhood of 5 to 6%. It means that capitulation is still many months away. We probably need to go to that double-digit core PCE before we get there.
I mean, I think at that point, you'll see long end yields, I think, head higher. But it's been, I was saying Bill Ackman, posted this whole tweet storm on, which I think to be honest, makes some sense. The market is reacting to this, how it was in 08. Quickly we'll enter this recession. And I mean, there are things, some long-term inflation numbers have come down. Gasoline prices have come down. Food prices have come down. But like you said, when it's, this is still, the US is primarily a service sector driven economy. And if those prices are not coming down or those wages are not coming down, the Fed has a long-term issue and they don't seem to be ready to deal with it. So,
Definitely.
yeah. Okay, cool. Anything else for the?
No, just want to wish good luck to our listeners and hope to talk to as many of them as possible this week.
Absolutely. Yeah. So as always, please reach out to us on Bloomberg, on email, on through HiveMind Slack room, even through Twitter, and love to answer anyone's questions. And also, as always, hear some interesting feedback, thoughtful feedback. So, okay. Good luck. Enjoy the weekend, and speak soon.